What if the biggest risk to investors isn't a recession, a war, or even interest rates? What if it's a combination of sky-high AI valuations and a mountain of private debt hidden through the financial system? Ask yourself this: if the market were to crash tomorrow, which ASX stocks could potentially offer investors a safer place to hide or even profit? We'll break it all down and give you our best handpicked stocks with insights from our government-accredited share trading education, which has our experts regularly called upon by major media Australia-wide. I am Philip Tortevsky, joined by senior analyst Janine Cox and Blueberry Markets Zoran Krezovic, and we are Wealth Within. Good evening.
Good evening.
Good evening.
Nice to have you both on, Janine. Thank you.
After a long weekend.
Yes, we're a bit groggy, but back to
reality.
business. Yeah, Zoran, thank you for joining, mate.
Thank you for having me.
Yep, I know you're still a fan favourite, which is very nice. Eh?
Time will tell.
Yeah, time will tell. All right. Now, over the past few years, investors have poured hundreds of billions into artificial intelligence, while private credit has grown into a multi-trillion-dollar asset class, fueled by pension funds, super funds, and institutional investors searching for higher returns. Now, the concern for some experts is that if the economic growth slows or defaults begin to rise, investors could quickly discover that some assets are worth far less than expected. And so could the next major market downturn actually be triggered by excessive AI valuations and growing risks in private credit? Janine, I'm going to ask you, because all the talk right now is, interest rates, and I'm losing my train of thought, but interest rates and inflation, yes.
Yeah, all the risks that go with that. And yes is the answer, really. And that's the bottom line, that we saw this prior to the tech wreck, we've seen this prior to the GFC, that we get these lofty valuations and investors think that it's just going to run on forever, and the tech side's no different. And in fact, when you look at a lot of these companies, if they're not profitable now when there's a boom time, then when are they going to be profitable? That's the real question.
Is it also more of a gauge on the market emotion or sentiment right now? Because we're getting all these mega IPO listings, and we're going to cover IPOs down the track in the show, so stay tuned for that. But when you think of the sentiment behind why now, surely that's telling us that right now the market is ultra bullish, and after ultra bullish, you know what comes next.
Yes, too right. And before the GFC, we had a similar scenario. Lots of listings happened. We see that over and over again. Why not? It's an opportune time. There's plenty of cash around, that's for sure. We know that. And the people behind these IPOs know that as well. And also, there's still that hunger for investing in the stock market and to make a profit. And while investors are not too pessimistic, but are more on the optimistic side, then they know they're going to get these IPOs filled.
Yeah, all right, fantastic. Now, if we did see an AI or debt-driven market correction, which types of ASX companies have historically held up best, and why? Zora, I'm going to ask you, because 2000 was a tech crash, 08 was a financial crisis. This one we're walking into potentially could be a bit of tech, but then if private credit is at play in debt, could also affect the banks. Where do we see
2007, 2008 was mainly the private credit that initially triggered it, wasn't it?
Yeah.
And then he obviously spurred and went into stock market and property market in the US as well, in some states or some parts of US. But look, I mean, AI does feel it's a bit of a bubble, just like dot-com bubble. I think we mentioned this on this show on numerous occasions in the past. Just feels like it. As you mentioned, Janine, valuations are very, very high, exceptionally high, 25 to 30 times. I mean, some of our banks are the most expensive banks in the world right now as well. And then you have a look at the, SpaceX and all these IPOs that are due to come through, and underwriting on like Citibank is actually projecting that SpaceX in 2030 will have an income of around 320 billion. And right now it's pricing over the next 12 months around 18.7 billion. So it's an exponential growth, but the big question is, will that unfold? Will this be sustainable as well? Because there has to be at some point some sort of liquidity drain out of the market to actually compensate and to actually enter these IPOs. To answer your question, to go one step back, I think we mentioned that prior to the show because we had a broad discussion. I think, healthcare sector is actually something that's performed really well in 2008. So if you have a look at the CSL, I mean, I know now it's probably not looking too attractive at the moment, but that's probably one sector that we could look at as well. And then I would probably look at, hedging yourself in terms of maybe owning some of the commodities as well, such as gold or gold stocks as well, just to compensate in case there is actually a hard downplay or hard drawdown. I think it's actually very hard to actually find a niche market or niche stock that will actually perform well when the whole market is in red. And I'm sure you guys have gone through, and I've gone through in 2007, 2008. But look, it can be found. You just have to be very, very niche and picky about it.
Yeah, it's interesting what you said about liquidity drain. Right now, I think that's what is affecting Bitcoin in terms of its capitulation. A lot of the money pouring out of there and moving into these massive mega capital raisings. But let's move on now. Time, if we were hypothetically preparing for a crash, what are the stocks people should be looking at? Janine, what have you got?
Interesting. Well, some of the ones that are historically seen as quality stocks that have already gone down, like CSL is a good one. So let's just have a look at that. First up, you can see there, I've got the monthly chart there on the left-hand side, and we can see that this stock has already fallen down to the level that we were expecting, and on previous shows we've talked about that. So it's hit that mark. That's a tick. Could it go further? Possibly. It's always a possibility that we see stocks that have been in free fall continue to take a dive, and we can see the angle of that trend sort of pointing to somewhere around the $60, $70 mark, and probably existing investors are saying, oh, please don't say that. But it's still a possibility that we could see a further fall there. So the risk is still high right now, even though a lot of investors will be seeing this high volume coming into that fall and a potential turnaround. It could be. But we've seen plenty of attempts at re-challenging previous peaks. So it's too early yet to tell, but I think this is a really good one to keep an eye on and to watch. And like Zoran says, it was defensive. If we go back and have a look at what CSL was like when the GFC hit, you can see it was a pretty small decline, and then it just went sideways as part of the overall move. A bit like Woolies, consumer staples, the same, but it had already had a significant fall prior to that in the early 2000s. So if we're looking at where we've seen this, we've already seen a significant fall now. So is it going to go much further? It's probably got more chance of going sideways, slightly down for a little while before it then takes off again, I think.
Zoran, I want to get your thoughts on CSL, mate, because, looking at even some of the latest 13F chapter filings out in the US, a lot of the hedge funds, the new positions being picked up were in this healthcare space. So when you look at CSL right now, is it a case of stay away or maybe start fishing? Yeah, it's a good point you raised, because I actually read today in Australian Financial Review, there was actually a quote from one of the analysts, I think might have been from NAB or one of the top major banks in Australia and globally. They did state that they are considering CSL has actually bottomed out. And my first question or point was actually, I looked at the chart and I was like, what are you basing your analysis on that it could be actually bottoming out at the moment? Are you doing it on fundamental basis or technical? Because I think both. Despite the bad news in the month of May, I'm still very actually short on this. So my consensus is that CSL is probably still got a little bit more downside to go. I can see a gap here over the past week or so. And Janine, you mentioned a good point. The volume has gone up, but that doesn't mean that obviously buyers are coming in. It could just mean that there is a high intensity pressure coming through, and the sellers are actually unloading even more to actually get out of their positioning, because as we do know, markets go up in stairs and come down in elevator, and this is a perfect example of that. So you know what, if you ask me personally, I still think CSL has got more downside. Janine has got a good point here. I'd probably say it's got to go anywhere between $55 to $60 for me to even consider actually looking at it on a shorter term basis. But right now it's a falling knife, and I wouldn't actually touch it at the moment. All right, well, let's get to our next stock then, Woolworths.
All right, the
Woolies.
next one.
Yeah, so Woolies is completely contrary and very different, in fact, in inverse relationship to what we're seeing with CSL at the moment. I actually really like Woolies for a number of reasons. I think if I do apply like a downtrend line or level of resistance here, we can actually see that it's broken through it. It's come back and actually retested it, and now it's actually on a monthly chart, it's looking quite bullish at the moment as well for the month of June. So as long as we can actually break these levels and take out the high, which is on, let me just have a look now. if I can get it right, at 38.24, then I would like to think that there is more upside on Woolies. And the good thing about Woolies is it's been consolidating to the downtrending for very, very significant period of time. And generally out of these ranges, when you get a breakout, you actually get a quite aggressive breakout. The pinned low in October 2025 is obviously a point of support. And we can actually probably do an uptrend line here as well. Weekly is looking really good too. The volume isn't supporting the move, which is a bit of a concern at the moment. But as long as the price can actually continue creeping up, then I'd like to think that Woolies is a good stock to buy.
I really want to get your thoughts here as well, Janine, because I remember a few months ago when Woolies was in that free fall, you were quite vocal saying, hang on a second, Coles is front running. Normally that relationship fixes itself up. And here we are today, Woolies back flying again. Have they missed the run?
At the moment, I think so, temporarily though. So if we have a look at the chart, like Zoran said, there's a fair amount of resistance around there, but there is a really nice angle that the stock's unfolded in, and these stocks do go contrary to each other quite often because the managed funds are shifting money from one to the other depending on what their exposure is going to be. But I still think that it could head up to challenge this high. However, if you're wanting the best run, I mean, you know, that was it. I mean, probably for another 6 months, I would say, for Woolies.
Yeah, all right, fantastic. Next one.
All right, next one we're looking at is APA. This looks really interesting. It's had a decent rise, pulled back, tested support and off again. I think I'm pretty much, convinced, I guess, that it hasn't had the best part of its run yet. Still got 17% to that high there. It's broken through a level that I thought it would actually pull back more strongly from. So there's this resistance through here. It had a pullback here. It's tested it. Well, it's still in the phase of testing it now, but I really want to see what it does after this week, because that reversal that we're now seeing with that blue bar you can see there is actually showing the strength of that support. So we just want to see that confirmed, because sometimes the stock will continue to trade sideways there. But if this ends up being a really nice base, even if it comes back through the low of this week just to make that consolidation and then turns around and moves back up, then I think I'd be happier with that position, that it takes that decent run up to the high, and then there's a possibility of it breaking through that $12 mark.
Yeah, all right, Zoran, quickly on this one, your thoughts?
Fairly bullish.
Yeah. All right, nice, short and sweet. But if you do want to get involved in learning how to build portfolios fitting, today we're talking about potential market crash stocks. Check this book out, How to Beat the Managed Funds by 20%. It is free, just have to pay the shipping. The link is in the description in this video below. If you do want to take things to the next level, go and check out the website, wealthwithin.com.au, and look at our diploma of share trading and investment. It is government accredited. I keep saying it every week, but you won't find another like it. So go and check that out. Check out the testimonials and see the amazing results our students are having. I know you were recently talking to a gentleman who, and we're potentially going to be doing, I don't want to say too soon, a piece on this, but managed to, was it double the super or do tremendous with their super over the last 12 months, which was
I've
crazy.
spoken to lots of people recently, a guy who's doubled his super, and I will be speaking to a lady who's done the same thing this week.
Yep.
And I also had a visit from a gentleman last week who was often been on the show, and that's Yas, which hello Yas out there, and he's done incredibly well, making a lot of money on more short-term trading.
Yep.
Yes,
Yep.
fantastic.
Yeah, it's awesome. And I mean, these people haven't been traders for that long. I mean, they've done the course and not long after getting these results. So there's a little snippet of what is possible and the results people are achieving, doubling their super, which is amazing. But let's get to our next stock.
Yep.
Zoran, what do you got, mate?
TSL Trends Urban Group. Really, really good. Very, very good. Seems like today you guys are actually picking all the good stocks. So
I had to, mate, for you. Otherwise, you're going to bash me if we are.
Nothing like that. We are friends for a very long time. But what I can say about this one is it's hitting some major resistance around $15 at the moment. It's consolidating very, very nicely. It's actually hit the low. It's after hitting the major low, which was back in October 2023, it's been actually kind of trending up on monthly charts. So that's really good as well. First thing that comes to my mind when looking at Transurban, I would like for those that are students or they finish the course to actually do a bit of analysis and comparison this stock versus the CSL, because CSL has actually kind of consolidated for exceptional period of time at the market top, or before he actually fell out of bed. So I'm not saying that's what's going to happen on this particular stock, but what I'd like people to do is perhaps, take this particular range, do analysis, and then do a bit of comparison as well. And then if TSL does take out the high of February 2020, which is $16.44, then this could be just a consolidation prior to the actual next move up. With CSL, we've actually seen something contrary, where the stock has never broken the all-time high. It's consolidated for a long period of time, and it's basically broken the major low and then fell out of bed. So, you got to find the comparisons. You got to look, historical data with different stocks as well. As long as they're within the same sector and they've got a similar behavior, then hopefully it can actually give you a bit of indication or how things are going to unfold. But I really like this one.
Yeah. Do you pay much attention to, because you raised CSL and TCL as a comparison, do you pay much attention to, because on one hand, you've got CSL that was a beautiful growth performer, really stable driver, cash generative, similar like TCL, yet certain things happened, certain catalysts happened with that one, which sent the share price falling. Something changed.
Yep.
TCL, again, stable plotter, good cash business. When you see that and you're talking about potentially the market getting a bit iffy, how much do you play on keeping things as are and saying, okay, you know what, I'm going to assume things are going to roll on, because really in downturns, these types of companies generally hold on really well, versus factoring in, okay, the TCL, the CSL scenario has changed due to certain, real factors.
Circumstances and fundamentals that obviously affecting. I get your point, what you raised, and I think it's really good. I think the key component here is what's been taught in the course, right? You're looking for the trigger points and for the confirmations on a particular stock. And we can actually see, if we go back on CSL stock, that that trigger point never came through, because we actually never saw their major high get broken, and which was around 300, and it was the month before, So the high in February 2020 when COVID hit, right? And when the market melted around 15 to 20%, that point never came in the future where the price has actually reached and broken the major all-time high for their trend to continue. And that's the point that I'm raising. So for the reason, the fact that the stock actually went consolidated sideways for a long period of time and has never broken that point, obviously is indicating something. And that's why I'm saying, whilst the TSL might be something very similar in terms of the story, you really want to get the confirmation point where the weekly or monthly bar is actually confirmed, the major top has been broken, and that trend is likely to continue. If that does happen, then obviously, hopefully, there is a fundamental aspect that's going to back it, and the inflows are going to come through, and the stock is going to continue heading higher. It's about patience as well, right, and being disciplined.
And I get from that, follow the price first. That's going to be your best marker in terms of what comes next, which is great. But let's move on to our last stock before we get into the break. We've got some beautiful information coming around the IPOs and more amazing stocks, so stick around. But let's get to. Now, this one's interesting, Santos.
Yeah, look, I think they're all interesting from the point of view that they've all had these major consolidations. So, we saw CSL, we saw TCL with its consolidation, Santos, another one, a huge level across here, which is sort of a beacon just standing out to you to say, like what Zoran's saying, you want to reduce your risk, so you need to know whether if it breaks that, then it may be time. Otherwise, it just keeps hitting its head there and then reverses and comes back down again. So, this looks good. It looks like it's trying to make that move. There's a bit of a gap down here, which, it could fall to fill that gap. And if it does, then I would just stay away from it for a while, because you need to just let it settle, let price do what it's going to do. And remembering that once you're in the trade, you don't control anything. You're just controlling except for what you decide to do. So that's where you've got to have a plan, and you may have a specific trigger. You may have a back-tested set of rules, whatever that is. But the most important thing is to where are you going to manage your risk. So if it shoots up and goes through, Be nice if my mouse was working, but you could set a stop loss underneath this low here, or whatever percentage you're willing to risk. That's one level underneath the low of that whole consolidation on the weekly chart, that recent one. Apart from that, I mean, I just think it looks really good the way that it's set up. It's the first time I've actually thought it looks good for a while. In fact, we've seen that high tested, and instead of making like CSL, Zoran was talking about before, it actually had this lower high, but then we can see that Santos has actually taken that out.
It's trying to break it.
Yeah, which is the critical point here. And but if you want to take a little bit of risk out of it, then you might wait till it actually breaks through it. Some might wait for it to go up a bit and then pull back to that level and then look to take another run. But, you know, it's all depending on what your risk strategy is.
Yeah. I'll just say one point before we move on. I think people need to understand how lucky they are actually to watch this, YouTube channel and stuff, because you guys actually put in so much good emphasis on stocks like these. They actually consolidate for such a long period of time and save a lot of people a lot of work. Because if you have a look at the CSL, if you have a look at Santos, if you have a look at the TSL, they've been consolidating for 5 or 6 years now. You have a look at Santos has actually created a major low back in 2020, right? And ever since then, whilst it has been in an uptrend, it's also been going sideways for a very, very long period of time. Now, if you get the major breakout out of the sideways range, then it's obviously only indicating one thing, that it's likely to head higher. I do agree with you as well, Janine, that obviously there is a gap here on the upside as well, which has been closed, but there is actually a gap to the downside as well. But if the price does come down and close the gap and comes back to retraces and breaks the $9 mark, then like this is the cleanest breakouts that you will actually get on any particular stocks. And I do recall a couple of months ago when we were talking about materials, BHP, Rio Tinto and other stocks, and I actually had a look at them recently over the past couple of weeks. Some of them are doing exceptionally well. So never underestimate the fact that the stock has been going for a long period of time sideways, because once you get those breakouts, they can be so aggressive, and you can trade short, medium or long term.
Yeah, no, thanks for that. And I mean, the proof's all over our shows for the last however many years. The market won't crash, tech's ready to buy, Drone Shield, EOS, Linus, Mineral Resources at $20. It's all out there. If you do want to check out what we've been saying, please go and check out the website and look at the catalogue, because you will be surprised at how many things have actually come to fruition. But let's get back to, let's move on, because we are going to get into some more amazing stocks coming up shortly. But now time for our trending topic this week, Janine.
Yes, and it's an exciting one at that, isn't it? SpaceX, it's scheduled to go public on the NASDAQ under the ticker SPCX on the 12th of June. And it's expected to have a valuation of around $1.75 trillion. So the question is, should Australians buy SpaceX? Based on its giant valuation alone, it will be the 7th biggest company in the US. The Financial Times reported that, and yet by revenue, the 200th biggest. So think about that. That should send investors alarm bells. Now, analysts have warned the company's valuation is being derived from the future expectations of projects like orbital data centres and Musk's reputation for building innovative companies like Tesla. The article goes on to say smart investors may be better off waiting to buy in the coming months when existing shareholders and company insiders have had the chance to offload their shares. Now, when investing in an IPO, you must understand the opportunity as well as your risk. Now, SpaceX is really an AI investment with plans to build AI data centres in orbit running off solar power in a way that is significantly cheaper and more efficient than anything on Earth. This forecast shows the vast majority of its market opportunity, an estimated $22.7 trillion, is for enterprise applications, away from rockets and spacecraft. The focus is on artificial intelligence, corporate cloud infrastructure and business-to-business networking. Now, what are the risks, and will retail investors be winners or losers? The fundamentals indicate the company is unprofitable. Last year, the company reportedly received around $6.8 billion US and spent $20 billion. Will this stop investors wanting to jump in? No. Many are going to suffer from FOMO, unfortunately, and I shouldn't laugh there, but we see it over and over again, regardless of what we say, people still do it. But savvy investors will wait for the sell-off. And we will take a look at Tesla shortly to get a few ideas. Now, around 50% of all IPOs trade at prices well below the offer price within the first 12 months of listing, especially those driven on hype. So why help pump up the price for those who are already invested ahead of the float? Understand your risks first. Second, learn how to read a price chart so you can time your entry and reduce your risk. Once the initial hype fades and the price falls, you can also determine how much you could make. Now, to me, that makes more sense.
And I said it perfectly because it's true. There is such hype around this right now. The biggest IPO in history ever. Yeah. That's what we're looking at.
Look, we have the biggest IPOs, the most amount of IPOs, the tallest buildings being built, these amazing technological advances, and then the market peaks.
Yep.
Not long after.
Coinbase 2021, AT&T before the dot-com crash, Rivian before the EV car drop.
So who's the smart one? Those who are already in it and that are listing it now, or the ones who are about to plunge their cash into it? Well, maybe for short-term traders it's an opportunity.
You really have to ask yourself, the job of private business is to get the best price possible to sell. And when you're going to do that, obviously you're looking for the best conditions. And right now, if euphoria is high, if hype is high, you're selling in the best conditions. But then you look at the underlying and say, okay, well, this company's not making money. You've got to put two and two together.
Musk,
Yeah, well.
That's what the argument is, isn't it?
It is, yes.
So if he wasn't there, what would the situation be?
Yeah. And eventually, I think the reality is it's all good and well buying the brand or buying the hype. Once you step over into the market, you're playing by the market's rules. There's a new set of rules. There's a new set of rules here because these rules will eventually get the big money or the smart money, look at it and go, well, hang on a second, I'm not going to pay 700 times earnings just because it's Musk, because I've not done that for any other stock on the market. You're going to get addressed like any other stock on the market, and if you're overvalued and overhyped, you will get punished.
And markets don't care if it's Elon Musk or who is behind it. Markets will discount everything as it is and basically look at it in isolation, right?
Initially they don't though. Like when I've seen a lot of these IPOs when they launch, initially the price just rockets up.
I agree with you.
People are trying to fill their positions and fund managers want a piece of the pie just so they can say that they got some.
Yeah, I think the fact that you said more than 50% of the stocks post-IPO actually downtrend or go at a discounted value, I feel it's like 70 or 80%. It's actually much more there. Have a look at calls when he listed a few years back, Medibank, a few of those like ASX shares. They all actually went heavily discounted after the IPO, and after 6 to 9 months, you can actually get it at a much better price. And not only that, you'll actually get a reflection of what the market truly thinks about it, as opposed to the actual hype, as you mentioned previously. So I think it's a no-brainer. I would stay out of it. I wouldn't buy it.
Well, what if we go and have a look at the Tesla chart?
Let's do it, yeah.
On the screen now, you can see the monthly chart of Tesla. TSLA is the code of the US market. And we can see that when it first listed, there was this euphoria initially in that first month. And I don't know the actual listing price, whether that's the starting price, but it was up 60% in that first month from the open down here. Following that, the stock fell 50% the following month from the high, and then just trundled along. So investors would have tried to pick it up. It's the same with a lot of IPOs when they try to pick it up in that first couple of weeks. And then it fell away significantly after that. But then it recovered and just trundled sideways, didn't do much for many years until around 2013. This is when Tesla took off. So that's from 2000 and what was it originally, 9, the listing? 2010. So you've got to remember too, when these things happened, this was actually after the GFC. So this is listing a company not long after the bottom, right? So everything's going to be up, from there. So timing has a hell of a lot to do with it. If you were to look at companies that were trading before the GFC hit, even good companies with good earnings, companies with terrible earnings. They're all going to fall. It's just the degree of it that's, because money just gets sucked out of the stock market. And it's going to cause prices to go down. And we're going to see that even more now because we've got that concentration of risk with a lot of major fund managers because of the ETFs. So, but I think it's definitely one to watch and learn from. We'll be reporting back on this down the track.
Fantastic. All right. Now, if you want the skills to analyse stocks just like you've seen tonight, visit our website, wealthwithin.com.au. But now let's get back to our topic and get into some more stocks. Zoran, next up, Woodside.
Woodside Energy, yes. Another good one, actually. Probably not as good as Santos, if you ask me, but it does have a similar gap, so gapped up. Both gaps on Santos and Woodside are in relation to the, obviously, Middle East escalation of the war, which happened in the month of April. So, look, on Woodside, it looks like it will come down and close the gap, which is positive. And then if we can actually reverse and take the high of 35.80 in April 2026, it's reached that point, and then we should be able to see this stock actually, continue heading higher. The next major level of resistance that I see here is probably around $39 or $40. And then obviously, we'd be looking at $45 to $50. But look, the volume is on weekly chart. The volume is coming off, so is the price, which is actually not a bad thing, to be honest, because obviously that's indicating that sellers are drying out, and at some point, hopefully, it can actually reverse and start going upwards. But Woodside is looking pretty solid. I actually don't mind that at all. I would like to see to close the gap and then start to head higher. But both Woodside and Santos are pretty good.
All right, taking a look at Northern Star is the next one, NST. We know that gold obviously has been on an incredible run, and Northern Star has had a massive sell-off from this high. So we've seen a 46% fall from the high to come back and test all the way back to November 2020. And I'm sure that people who were picking it up all the way up here had absolutely no idea what it was heading toward, and now just in a massive loss sitting there. But I think there's a huge opportunity here with Northern Star after this correction has unfolded to see this bottoming out below the $20 mark. And you only have to go back and think, well, okay, it was trading back, at least 6 years ago, back around these levels at $16, and it's not too far away from that now. What has it done in the past? It's done a similar thing. There was a prior high here in 2016. It came all the way back and tested that high. It's doing a similar thing now, but look at what it did after that. I mean, it actually had one of its most significant runs to the high in 2020 at 185%. Well, what could we see going higher? $40. It's realistic for Northern Star if it manages to find this bottom here and hold, and then start turning back up to test that top. So I think that, we could see further upside with gold going forward.
Well, that's another one. I mean, we were vocal on gold and silver saying that it's hype-driven over the last couple of months. It's got to come back, and now we've seen a 30-40% correction. So there's another one on the list if you want to add it. But next stock, EVN, Zoran.
Evolution Mining.
Yeah, and I want to get your thoughts now at some point. Gold is really selling off. It's broken lows again overnight. At what point does the opportunity get exciting for these gold players? Is it now or a little further?
I think it's still got time to wait. Yeah. I would like to think that both gold and silver have probably a little bit more downside to play. Number of reasons, more so fundamentally than technically, to be honest, on this one, because I'm looking at more of a macro view. Because, like treasury yields in the US and in Australia, both actually starting to creep up over the past few months, and we've seen 3 interest rate hikes in Australia. We've also, we're seeing the Fed is pricing a 65% chance there will be another interest rate hike coming in US until the end of the year. So inflation is going up. We've seen non-farm payroll data on Friday come really hot, and then in the month of April and May it was 185 and 115,000 respectively, way higher than what market consensus was. So I think labour market is really strong as well. so there's a number of factors that are pushing the inflation up, and if the yields go up and interest rates go up, then I'm starting to think the gold and silver might actually come off a little bit as well. But going back to Evolution Mining, I would like to think there's actually more downside on this stock, probably a little bit different to Northern Star, only on the basis that it's actually looking fairly bearish. It's got an outside bar, inside bar, down bar, and another inside bar. So as long as we can actually take out the low of $11.27, I think it can actually come down to close this gap, which is around $8.68, in between $8.68 and $8.72. So if we can close that gap and come a little bit further down, then we might find some actually ground between $6.50 and $7. This would be a sweet spot for me personally, if the stock can actually come back and consolidate. If not, then obviously there's more downside, but if it retraces a little bit higher and consolidates and we see overall move in gold, sentiment kind of changing and becoming more bullish, then I find a lot of these stocks would actually follow that trend.
Yeah, all right. Next one, Janine.
All right, now we've got the other side of the fence. This is Coles Group, and we've seen that big run that we looked at Woolies and saw the rise happen. Now we're seeing consolidation from Coles. So I'd say, look, once it gets through that high there in April 2026, it's going to head for the sky. It's going to try to push through again, and it's quite possible that we could see that run keep going up around 27, I believe, probably around that level. So at the moment, I'd say don't discount Coles. That was not a joke, but it still could potentially have a further run. If it just trades sideways for a while, the longer it goes sideways, then you have to be prepared for a test of the downside then more so. And so I'd be watching that level there. But at the moment, it's holding up well.
Yeah, all right, Zoran. Now, the last one, Telstra. This is another good example of IPO capitulation and then comeback story.
Comeback story, yeah. Once upon a time, darling of the market, and then another point in time, the absolute dog of the market, if I can say it that way. And I do remember those times. Look, it's looking solid. It looks like we've actually created some major lows back in 2018 and back in 2020 when COVID hit. I think the whole sentiment and the narrative around this stock is actually starting to change, which is looking really positive because the stock is actually come back out of the woods. It's consolidated for a long period of time. It's broken through in another uptrend, and now it's actually coming back to test it. So if you do take out the low here, which is 471, which is very realistic, I would expect this stock to actually come back to around $4.50. If it holds around here and then it starts gaining momentum, then we could be actually seeing this coming quite a bit higher up. Let me just do this and get it right. Yeah, and I'd be looking at probably $6. And then obviously testing this major high, which was in February 2015. But overall, the stock is looking fairly bullish. I do like it. I think it's looking quite solid. And as long as this narrative can actually continue, then it should be good. Should be good. I mean, it's a good income stock, or it has been in the past. Top 20, a lot of volume. Darling for fund managers and asset managers as well, with a good yield on it. Yeah. Good option. Good option.
All right, fantastic. Now, before we move on, let's get the pick of the bunch. I know what yours is probably going to be, Zoran.
Yeah.
What are you thinking?
I'll go with Santos.
Okay.
Yeah.
I was thinking Telstra, but Santos.
I was just pointing to Santos too. You took mine.
That's all right. We can have two Santos.
I'll go with Transurban. I can pick any. They're all pretty good, actually.
Santos. Oh, he likes Santos, so I'll go for Northern Star once it's actually finished bottoming out.
There you go. Nice. Gold and energy. Now, moving on. Shortly, we're going to get into our hot stock tip, but first, let's answer your questions. Paul writes, the stock market is often used as a measure of economic health, but many people don't own significant shares and may feel or not feel the benefits when markets rise. Do you think the stock market is still a good representation of how the broader economy is performing, or has the connection between market performance and everyday Australians become weaker over time? Well, I mean, was the market ever really a representation of the broader economy? I'm not so sure.
Yeah, there's always a disconnect.
Yes.
they don't form, or the cycles don't form exactly in line. There's a sort of, I guess, a cyclical gap between the two, one following the other. And the market is supposed to factor things in 6 months in advance. So if you think about it that way, and the perception, I guess, is probably more important than what the actual economy is doing at the time, in my opinion.
Well, the easiest way, I guess, to make that assessment was stock markets are at all-time highs, and yet we've got this cost of living crunch, here. We're economically, especially Victoria, it's not great. So there is a disconnect there, and it's obvious. Your thoughts on economy and stock markets?
I think it's a bit of both, to be honest. I agree with Janine. I think stock market tries to front run the economy, domestic economy or global economy, probably 6 to 12 months ahead. But at the same time, there is kind of a bit of a disconnect as well, because there is, just because there is a certain valuation on a stock and it's performing and doing really well, it doesn't it doesn't show the sentiment within the economy, whether it's the growth, whether it's the inflation or whatever that is. So, I think it's a bit of both, to be honest.
Is there? I think the bigger question that comes, and I want to get both of your thoughts on this, is that if we are moving into this world where capital is becoming concentrated, and it is through ETFs, index ETFs are so popular, all of this capital that would often flow in diversified areas of the stock market is moving into top 200 or top 100 or top 50. When we get this concentration just fueling these same stocks more and more, surely that disconnect's going to get wider and wider.
Yeah, I mean, that's normally what happens when the market goes to peak out. We do see that disconnect. Yeah. But I guess my question would be, why is this so important?
Yeah, why do you care, yeah?
Why do you want to know that? That's really my question, because, is it you're trying to track what the economy is doing so that you have an idea of because there's so much talk about what's happening in the economy, and therefore if you know the economy's, failing or going well, then you make a decision about whether to put your money into the market. I mean, a lot of people do that who have no idea about what's happening on the charts. So that could be just a lack of understanding about how the stock market moves. So I think the book is a really good example of how to actually think through these things, really.
And I think what you're saying, and this is an important point, if you can flip your mindset to thinking about investing or markets in terms of risk more so than prediction, then your whole world will change, because you're not thinking about what's going to come tomorrow. You're focusing more on going from point A to point B and making a profit on that exact asset that you trade. Because the reality is, as you know, the markets could be, the economy could be in free fall, and yet semiconductor stocks can make you a fortune.
Yes. Well, they can learn how to do sector analysis, technical analysis across the sectors or the major stocks within those sectors that are going to show you what's going to happen anyway.
But I also see this student or this person, sorry, I forgot the name, but I see their view, because there's actually so much noise in the market as well at the moment, and it's making a lot of people feel very overwhelmed as well, because there is actually a FOMO in the market right now. There is a lot of people that I talk to on daily basis at Blueberry as well, who are like, there's this narrative that everything is moving to the upward trajectory at the moment, and everyone is talking. It's so funny, because if you're not filtering through to what's happening globally and domestically, you would think that the whole market is doing this amazing thing, but that's not the case. It's not the case. It's actually isolated parts of the market that are doing exceptionally well, and the media is driving that narrative, right? And then when everyday person reads news or takes newspapers or goes on internet and stuff, they do feel overwhelmed. And if the knowledge is not there, they do feel like they've got a massive FOMO, fear of missing out. That's right. So they do start asking a lot of these questions. So I think it's a great question. I think it's a hard one to answer, though. If you're looking at it from monetary policy and post-COVID, where a lot of money infiltrated into the financial markets and a lot of the money is going into the economy and it's going into the stock market, then you would think, oh yeah, things are happening, everything is amazing, there's a lot of disposable income on the households and investors, and stock markets are going to go up and it's going to continue that. But it's not how it works, unfortunately. It's not, and sometimes all it takes is actually one thing to trigger, and then it's a flow-on effect, and it's a domino effect on the rest of the market. And before you know what, we have trouble.
Like one earnings report coming out of the big boys.
Correct.
But, let's move on. That was a good discussion. To Adam's email, who says, I was hoping that your team could cover more of the whole AI revolution and its massive significance that many seem to be ignoring. AI may resemble past technology booms, but there are key differences. Today's AI leaders are already highly profitable. Governments view AI as strategic geopolitical assets, and many investors see it as a tool to solve disease, aging, and scientific discovery. More broadly, AI taps into humanity's search for higher intelligence, making it a potential once-in-history transformation despite inevitable periods of speculation. Now, I don't necessarily know what the question is here, if it's a statement.
But to me, it means that if it's a once-in-a-lifetime scenario, which is what he's mentioned, then it just means that this could influence the boom to go longer. Like they had the Industrial Revolution, and that caused the boom to go longer. So could the AI.
Yeah, and you know what? We're all geniuses in hindsight. History is a wonderful thing because rewind back to 2000, and the internet was the thing that was going to revolutionise the world. We didn't know about AI. And all of the talk was, okay, it's going to do this, it's going to do that. And yes, it did. But the reality is in markets, there is speculation, there is valuation. And you need to decide, I think, more importantly than this, sure, AI could be this amazing transformer of the world. But at the end of the day, if you're investing, you need to understand timing. You need to understand when it's opportune time to get in, to get out. You need to understand that there's volatility and separate the two. Because if you fall in love with a story and transfer that over to investing and have no allocation or thought for risk, then in my opinion, you shouldn't be in the market because you're going to get slaughtered. And so separating the two, knowing what you want from each goal, because for me, and I'll ask you the questions, I go into the markets for profit. I don't really care about anything else, and I might sound like a capitalist or thing, but I'm being honest. And I think that's 99% of people, if you ask them honestly. So are you guys of the same idea here? Or?
Yeah, absolutely.
Yeah.
I mean, majority of people go into the stock market to profit and make most of it.
A lot of people go into the stock market to build their long-term wealth.
Yes.
Or to generate an income.
Yeah, which... The story behind it is great, but maybe for, I don't know, a technology channel, for us, it's all about trading and investing. So anyway, thank you very much for emailing. Daniel is next and writes, I wanted to get your thoughts on Xero. I've been watching this stock for a while and it took a position at $86. I was considering getting in at 75, but I wanted to take the extra bit of risk off the table. I've set a stop loss at 77. Can I get your thoughts on this, please? All right, Zoran, this is more up our alley. Xero. Yeah. Buy, stop. What do you think?
Look, not a bad. I mean, it depends. So when you go left-hand side of the chart, which is obviously monthly chart, which is a little bit more concerning to me. But then if I have a look at on the right-hand side, then I'll look at his point where he bought in and probably the reasons why he bought in. If he's done the course, then I can actually kind of understand this point of view. I still feel the stock, he might find the bottom. It certainly may, and I would like to see this being a major low, higher than the lower low which happened back in 2022. But overall, it might be just a sideways consolidation before the stock actually takes another dive lower. So that's one way you can actually look at it, right? Because the move to the downside has been super, super bearish and it's been super aggressive. So that's one way to look at it. The other way to look at it is that this might be the actual bottom, right? Now, the stock itself for this week is looking to close around $79, 72 or 27? 27. And his entry is $86. I personally would like to see actually a weekly close above this high, which was at $87 mark. For me, that would give me a little bit more confidence that the stock is actually on the upward trajectory.
What about placing a stop at $77, considering where the area is, trying to trade reversals with such risk? Do you think that's a good spot or?
Yeah, I mean, look, in percentage terms, I can't calculate in my head whether he's doing 10, 15% or whatever, you know, what.
Still.
Yeah, but I still feel that the stop might be a little bit tight. Like very, very tight. I mean, if he's looking for a very short-term trade and like impulse move to the upside and taking profit off the table, that's fine. But if you're thinking more of a medium to long-term, then I feel 77 might be considered as a little bit of a tight stop, only because the stock might actually consolidate and go sideways for a substantial period of time. If that happens, I've seen it over with people's trading, including mine. It whips you in and out.
Yeah.
And once it starts whipping you in and out, then you might look for another entry. And before you know it, you're actually not sticking to your strategy. You're more so going back on the emotional side of trading, and that can spiral into a whole heap of different things.
Yeah, or you don't take the next opportunity and then you miss out on the run. Because I think in this instance, he's probably already stopped out. Your view on that stop, is it?
It's more like not just the stop. I mean, it's tight, yeah. But I guess given where it's trading, you know that there's a higher risk that you could get swung out than whether you're weighted for this bounce. But at the same time, we've all seen stocks off these lows that just rocket off, and it could just take off to around that $100, $110 mark. So there's still a possibility that it could recover, but it's just a question of if you put a tight stop, you could get stopped out quick, and then you've got to reposition yourself and get back in. So it's that mental game of knowing that if you get stopped out here, where are you going to get back in again, and have already thought through that.
Yeah, all right.
I'll just add one more point for this particular student. I personally would like to see a stop loss probably somewhere below the $67. What is this? This major low, which is 67.93. The reason for that is because it's a major low within this range. And if we see weekly or monthly chart break that major low and continue heading lower, then to me, I would be okay to get stopped out at that point, because I would like to be inclined that the price is going to continue heading lower. And then obviously I would be watching for another re-entry at a much lower price.
Yeah, absolutely. I think the stop on 1 week's volatility is very high risk. But anyway, some learning there. Now time to move on for our hot stock for the week. Zoran, what have you got, mate?
Yeah, the hot stock tip this week is Megaport Limited. Recently, the company has raised about $511 million through the institutional component of its $827.3 million entitlement offer, with shareholders taking up 99% of the entitlements. Funds will be used to acquire NVIDIA GPUs and build AI computing infrastructure for customers. Serial lifted its target price 41% to the upside to $22.10, increased its financial year 2027 EBITDA forecast by 73%, and said execution risk remain manageable. Let's have a look at the chart now. So, the recent price is obviously reflecting to the upside, and very, very aggressive move at the moment. It's gone up 131%. Weekly or monthly chart does not reflect daily fluctuations in the price, and it also doesn't reflect a lot of gapping on daily charts. However, if I do have a look at the key levels of resistance here, so around $21, $22 is an all-time high, and I'd probably like to consider that point as a major point of resistance, given though it's actually broken this level, which is around $17.50. On a stock like this, I would expect it to come back and retrace. I do feel it's an emotional move. I will have a look at it on weekly chart for a little bit more noise. It's got quite a bit of gapping on daily chart as well. Overall, I think it's probably got a lot more upside. However, in the interim and in the short term, I would like the price to actually come back and probably test that $16. I think that would be a good base, retracement, consolidation, and then hopefully it can actually continue heading higher. Alternatively, I'd be looking for a weekly or monthly close above that all-time high $22. And then if you're looking for a short-term trade, there might be an entry point.